Dear viewers, welcome to our channel GVS Bank Academy. Today I am going to discuss about CAIIB Bank Financial Management Memory Record Questions 121 to 140. This is part 11. Question number 121. What are the main causes for the global financial crisis in 2008-9? What are the main reasons for the US subprime crisis in 2008? The main reason is at the time the foreign banks, US banks are excessively using the credit derivatives for credit risk management. For credit risk mitigation, they had used excessive credit derivatives. But the underlying assets against the credit derivatives are poor quality. The banks, after default, they are not getting the realization. That's why the quality of the underlying assets under credit derivatives are poor. Means they are not getting the value from this derivative underlying assets. That's why the main reason is excessive use of credit derivatives for credit risk mitigation, and the underlying assets, the quality of the assets are very poor. Realization they are not getting as per the outstanding amounts. That is the main reason. That is question number 120. Question number 122. Nodal agency. Nodal agency designated by Government of India to manage the Export Marketing Fund, Exim Bank. Nodal agency designated by Government of India, Exim Bank. Question number 123. AD category 1 branch. Authorized dealer category 1 branch. What is the definition for AD category 1 branch? AD category 1, authorized dealer category 1 banks means that the branch bank can directly deal with foreign currency. Number 2, they are allowed to open foreign currency accounts directly also. So AD category 1 banks can assess the updated list of caution listed exporters with RBI through EDPMS, Export Data Processing and Monitoring System. As of today, from 2014 onwards, RBI was developed this EDPMS software. All the things you have to updated in the EDPMS software. Now, after updation on daily basis, we can view the status of the exporters. Yes, it is permitted on daily basis. This question was asked whether AD category 1 banks are permitted to view daily. Yes, it is permitted. Sometimes they are asking EDPMS, Export Data Processing and Monitoring System, abbreviation also. Question number 124. Three types of forex exposures. Forex exposures are: one is transaction exposure. It is related to transaction. Any purchase of foreign currency, sale of foreign currency, accepting of deposits, repayment of deposits related in foreign currency, booking of forward contract, sale of forward contract, any transaction related foreign currency, that is called a transaction exposure. Translation exposure means at the time of consolidation purpose, Indian banks which are having foreign branches, all the assets and liabilities of the foreign branches, they are converting into domestic bank branch balance sheet for consolidation purpose on 31st March. At the time, that is called as translation exposure. Whatever the rate declared on 31st March, that rate is going to be used for translation of foreign currency assets and liabilities into domestic currency on 31st March for consolidation purpose. That is called translation exposure. Economic exposure means the banks are mainly dealing with the transaction and the translation exposure. Economic exposure, banks are not dealing directly, but some companies are facing this problem because of technology changes. Some products are disappearing in the market. When the products are disappearing in the market, the companies are facing huge losses. That is called economic exposure. Economic exposure. Now, 125, question number 125, or power of POA, power of attorney holder. In NRA accounts, NRE customer had given a power of attorney holder for a customer, or power of attorney holder of NRE customer allowed to create foreign currency notes and traveler checks to NRE savings account. No, it is not allowed. Why? any crate of foreign currency notes or traveler checks in NRE or FCNR accounts by the customer only. By the NRE customer only. No outsider is allowed to create in foreign currency notes and traveler checks. So, if customer wants personally to deposit, that is allowed. Otherwise, any third party, including power of attorney account holder, is not allowed. That's why answer is no. Now, question number 1 to 6. What is the difference between credit default swaps and credit linked notes? Very difficult question. Without understanding credit default swaps and credit linked notes, answering this question is very difficult. So, credit default swap means it is a credit derivative. Credit default swaps are generally off balance sheet item. So, it is a derivative. Credit default swap is a credit derivative. So, credit derivative means it is a off balance sheet item in the balance sheet. Now, credit linked notes. Credit linked notes means on balance sheet items. Sometimes the banks are selling under securitization. Credit linked notes. Please listen very carefully. Credit linked notes means in the off balance sheet item, on balance sheet item. Sometimes banks are selling under securitization or loans they are converting into securitization. Through securitization, they are converting the banks are converting the loans into notes, credit linked notes. So these notes, the securities are underlying securities in the credit linked notes are whatever the securities are there in that advances credit linked note means in that advance that is the security in the credit linked notes. Credit linked notes are on balance sheet item. So credit linked note or on balance sheet item. CDS credit default swaps are off balance sheet item. Number. Why this is credit linked notes are on balance sheet? Because this is generating from conversion of a particular loan into underlying security they are issuing in the market. That is credit linked notes or on balance sheet item. That is also equivalent to credit definitions which combines credit derivatives. So CDS credit default swaps are on off balance sheet and credit linked notes are on balance sheet item. Question number 1 to 7. What are the forex market characteristics? What are the features of forex market? Forex market is a most liquid market, most liquid and most dynamic financial market, forex market. So the forex codes are changing every 4 or 5 seconds. The rates are going to be changed. That is called dynamic financial market. Now forex markets are 24/7 because these markets are worldwide trading 24/7 because of geographical disadvantages. Our bank is function, our country by 5 o'clock we are closing. After closing, some countries banks they are opening. That's why we can say this is a 24/7 market. And mostly forex markets are interbank dealings are more because directly for customers dealing in in the forex market is less when compared to interbank market. This is market related to interbank and mostly forex transactions or transparency is more because this is online trading. Online trading, market transparency, rates transparency, whatever the rates we are purchasing or selling, we can view on the online also. That's why we can say this is a transparency. So these are the forex market features of this question number 127. Now question number 128, very important for all the examinations. Exchange earners foreign currency account. Most of the times they are asking case study for 3 to 5 marks. Theory based case study. December 20 also they are asked. Now EFC exchange earners foreign currency account is a foreign currency current account. Current account. EFC account is a current account. Means current account means no interest. And this account is going to be maintained with AD category. AD category means authorized dealer category 1. Authorized dealer category which you had already discussed. These AD category 1 branches are allowed to open foreign currency accounts directly. That's why this is, which is a foreign currency account, current account, no interest, opened only with the AD category 1, AD1 category. No interest is payable on EFC account. We can open this EFC account. All categories of foreign exchange. All categories means those people who are earning the foreign exchange, they are allowed to open this account, such as individuals, companies, or any other firms also, who are but resident in India. Such individuals or companies or any other person, they are resident in India, may open EFC account. How much amount they can credit into this account? Yes, 100% of their foreign exchange earnings can be credited in the EFC account. Whatever they are earning, 100% of the amount they are allowed to credit in this account. But one condition is there. Whatever the amount outstanding in this foreign currency account by end of to the condition that the sum total of the accruals in the account during a calendar month, what are the outstanding in this account by the end of the calendar month means current month. Example, by end of the current month balance should be converted into Indian rupees or on or before the last day of the succeeding month. Whatever the outstanding balance during the current calendar month, that amount is going to be converted into rupees or directly they are allowed to pay EFC, foreign currency payments during the next month, succeeding month. On the last day of the succeeding month, any balance outstanding, that amount is going to be taken over by RBA. That is. SEZ units cannot open SEZ units. SEZ units. But a unit located in SEZ. SEZ units cannot open EFC accounts. Why? SEZ units are already allowed to open foreign currency account. That's why specifically SEZ units are not allowed to open this account. A unit located in a special economic zone can open the EFC account. Here you have to understand SEZ unit is different. A unit located in a special economic zone. So this is very, very important. They are asking repeatedly for 5 marks question. 5 marks question. Now question number 129. Disclosure about market risk in trading book. Market risk. So banks have to maintain capital charge or capital requirement for credit risk, market risk and operation risk. For market risk in trading book. Trading book means outstanding position in held for trading and available for sale. That is called trading book. Trading book means held for trading and available for and derivative trading and gold open positions comes under trading book. Now, what is the disclosures required? Market risk in trading book. Interest rate risk means interest rate fluctuations. Net positions, horizontal disturbances, vertical disturbances also will come under interest rate risk. On this we had already uploaded one YouTube. Equity position risk, equity market related. Equity position means equity risk. Equity means shares, share market exposure. Specific risk and general risk and foreign exchange risk. Under the 3 items, they have to disclose the market risk. Each and every bank operating in India, they are disclosing under the 3 heads only. Now, that is question number 120. Question number 130, price volatility of a bond. The fluctuations in a bond prices will depend generally on basis point value. Higher the basis point value, higher the chances for fluctuation and yield fluctuations and price. Yield is going on increasing means price will come down. Yield is coming down, price will go up. So yield and price both are inverse related. Both are inverse. That's why you have to note yield increases, price will decline. Yield is coming down, price will shoot up. So that's why the price volatility or price changes of a bond depends. Question number 131. Market risk in treasury. Market risk in treasury. Treasury means investments. That trading book. Market risk in treasury can be controlled by, can be managed by stop loss limits. Stop loss limits. These stop loss limits mentioned in treasury or investment policy of the bank. Stop loss limits or cut loss limits. So when the share prices or investment prices are coming down, as per the given stop loss percentages or amount, they have to cut the losses. That is called stop loss limits. Sometimes they are asking 5 marks case study on stop loss limits also. Gap limits. Gap limits means Gap limits means if a bank is dealing with so many foreign currencies at the time, each currency wise they have to fix the gaps and overnight exposure limits. Through these three steps, one is stop loss limits, that is called cut loss limits, gap by putting the gap limits for various currencies, plus overnight exposure. How much overnight open position can be allowed? By putting these three limits, the bank can mitigate, reduce, control the market risk very well. Now, stop loss limits, who will decide? The top management will be decided and it will be mentioned in the investment policy or treasury policy of the board. That aggregate gap limit, AGL, means if a bank is dealing so many foreign currencies, the that all the foreign currencies limit is called as aggregate gap limit of the bank. Aggregate gap limit of the bank is equal to sum of individual currency limits. Decrease sum of individual gap limits. For example, dollar. For example, pounds. For example, Japanese. Sum of individual cap means individual currency limit. If we can add receipts of that currency and payment of that currency, or over short long portion minus short portion, that is the gap. If you are computing on a currency wise, that is called individual, and if you are adding all the currencies of a particular bank is dealing, that is aggregate gap limit of the bank. The AGL, aggregate gap limit, means total gap limit of the all the foreign currencies which the bank is dealing is approved by RBI after board recommendations of the bank. How much a bank can take aggregate gap limit should not exceed 6 times of bank's total Tier 100. So any bank in India operating in India, they can take aggregate gap limit which the bank is dealing should not exceed 6 times. So whatever the aggregate gap limit of either short portion or long portion without netting, you have to calculate number one, that should not exceed 6 times of Tier 1 and Tier 2 cap. Then net overnight exposure. Overnight means net open overnight means uncovered portion by the day end, or it may be overbought or oversold limit. That is called NOOPL. Net overnight open positions. NOOPL, net overnight open position limit, may be fixed by the boards of the respective banks, and it is to be communicated to RBI. Now, this limit, NOOPL limit, should not exceed 25% of bank's total Tier 1 capital and Tier 2 capital. Should not exceed bank's total Tier 1 and Tier 2. This question is very, very important. That's why I had explained in detail. Question number 131. Question number 132. The recognition of insurance mitigation. So under advanced measurement approach, for operational risk, under advanced measurement approach, how much percentage we can mitigate the operation risk by taking a insurance? That is called the question. The recognition of insurance by taking a insurance product, insurance policy, how much mitigation will be limited to 20% of the total operation risk. So whatever the capital requirement for operation risk is there, out of that 20% of the operation risk we can mitigate by purchasing insurance product under advanced measurement approach. This is the question number 132. Question number 132, dirty price. It is comes under investments. Dirty price is equal clean price, or clean price means face value of the bond plus accrued interest, up to date accrued interest also will be added. That is called as dirty price in treasury language. Dirty price, face value of the bond plus accrued interest up to date, or clean price plus accrued interest. That is haircut definition. Haircut. This question they are asking various examinations. Haircut definition. What is the first you have to understand what is meant by haircut. The actual market value of the security, the difference between the actual market value and the value ascribed to the collateral security. So if you are taking some security as collateral, market value is, for example, 100 rupees, for example. We are taking the value of the security for collateral security 85 rupees, means haircut is 15%. So the difference between the market value and whatever the value you have taken for collateral security purpose, the difference is called as haircut definition. Actual market value and the value assigned to collateral security. Now, normally haircut for currency mismatch. So loan is in one currency and security is in another currency. That is the meaning. Currency mismatch means loan is in INR, securities are in other foreign currency. At that time, whatever the value of security is there, you have to deduct minus 8%. Value of security minus 8%. That is currency mismatch. Gold. Whenever the bank is accepting gold as security, mismatch is haircut is 15%. These are the standard haircuts given by RBI. Debt securities for more than 1 year and up to 5 years. So debt securities more than 1 and up to 5 years, and the rated these bonds are rated AAA to AA. Haircut is 4%. Debt securities more than 1 year and up to 5 years, AAA to AA rated bonds 4%. Beyond 5 years, debt securities haircut is 8%. AAA to AA rated bonds 8. This is some of the haircuts I am discussing. Cash margin. Bank owned FDR. You are taking as collateral security as cash margin. Bank owned FDR, NSC, KVP, LIC. Haircut is 0. There is no haircut for this. So these are the standard haircuts for this at the time of calculation. Now, question number 35, 135. Banks are permitted to borrow from outside, overseas, or banks are permitted to allow to invest overseas. How much? That is the ceiling. So either borrow. If a bank is needed foreign currency, it can borrow. If a bank is having surplus funds, it can invest. How much? 100% of unimpaired tier 1 capital, means adjusted tier 1 capital. After adjustments, unimpaired 100% of unimpaired tier 1 capital, adjusted tier 1 capital, or minimum $10 million, whichever is higher. Either it can borrow from abroad or it can invest abroad. So this question also, banks are permitted to borrow from overseas or to invest in overseas market, 100% of unimpaired adjusted tier 1 capital. Now, question number 136. CAIIB stands for, this question, CAIIB, Central Repository Information on Large Credit. This is the CAIIB abbreviation, Central Repository Information on Large Credit. This question is very important for promotion examination also. This CAIIB developed by RBI, operated by RBI, maintained by RBI. Now, banks all big advance, CAIIB reporting to RBI in 5 crores and above, all fund-based and non-fund-based advances. All banks have to report 5 crores and above fund-based and non-fund-based advances to CAIIB report. CAIIB main report, monthly reporting, once in a month. Any default is noticed in that borrower account and the outstanding is more than 5 crores and above, weekly reporting every Friday. every Friday. So some important points I am repeating. CRILIC, Central Repository Information of Large Credit, developed by RBI, operated by RBI, maintained by RBI. CRILIC reporting to RBI, 5 crores and above, all fund-based and non-fund-based advances, all banks have to report to RBI. So CRILIC main monthly reporting is monthly reporting. If any advance, any borrower account, default has been taken place. Default means even one day default also. SMA 0, SMA 1, SMA 2, defaults are and NPA, all you have to report to RBI every Friday. If any bank is not reporting the eligible account, the bank has to maintain accelerated provision as per RBI direction. Question number 137. 137. Exam. This question, FRA. A bank is giving a quote on 10/4/2020, 10th April 2020. A 6 into 9 FRA. FRA means forward rate agreement. At Mumbai Interbank offer rate 5.45. So the bank is offering a quote on 10/4/2020. A 6 into 9 means 6 months into 9 FRA at Mumbai Interbank. In the transaction, what is the settlement date? What is the maturity date? Very important and very difficult also. FRA means forward rate agreement. First you have to know FRA, forward rate agreement, used for short-term interest rate risk hedging. Why FRA used? This is a short-term, one-shot period interest rate risk hedging instrument, number one. Now, when the bank is entering a transaction giving 10/4/2020, but the contract is going to be settled after 6 months. 10/4/2020 after 6 months means settlement date of FRA 10/10/2020. 10/10/2020. Entering on 10th April, 6 months means 10th October 2020. That is 6 months. 6 means 6 months. 6 into 9 means 6 months into 9 months. That is the meaning. 6 into 9. 6 months means from the date 6 months. That is the settlement date. And what is the maturity date of forward rate agreement? 9 months from the date. 10/4/2020 plus 9 months. 10/4/2020 plus 9 months means that is 10th January 2021. So 6 into 9 means first date is the settlement date, last date is the maturity date. One peculiar point is there in the forward rate agreement. The commencement date is the settlement date. On the date, the difference amount of the rate of interest is going to be settled in this. So this is about FRA. Sometimes they are asking 5 marks case study on FRA, forward rate agreement. Now, question number 138. 50-day volatility of the stock is 4%. For a 50 days trading, volatility of the stock is 4%. Find daily volatility of the stock. Daily volatility. So what is the formula? First you have to calculate square root of 50. Square root of 50 means you will get 50 square root is equal to 7.07. 50 days volatility of the stock is 4% means first you have to calculate square root of 50. So square root of 50 is equal to 7.07. Then after that, what is the volatility of the stock 50 days? 4%. 50 days volatility is 4%. What is the daily volatility is equal to 4 divided by 7.07. 4 divided by 7.07. Daily volatility of the stock is 0.56%. Daily volatility of the stock is 0.5. Once again, 50 days volatility of the stock is 4% means first you have to calculate square root of 50. That is square root of 50 is equal to 7.07. After that, next step is 50 days volatility is 4%. What is the daily volatility is equal to 4 divided by 7.07 is equal to 0.56. This question, compulsory question, they are asking in each and every examination. Question number 139. Treasury bill is issued for 91 days treasury bill. Issue price is 98.50. Face value is 100. What is the yield on this transaction? In this transaction, how much the yield the investor is getting? That is the question. So issue price is 98.5. face value is 100. On maturity, after 91 days, the investor is going to get 100 rupees. 100 rupees. Investment is 98.50, getting after 91 days 100. So interest party is getting, investor is getting 1.5 rupee. 100 minus 98.5, that is 1.5. That's why 1.5. Whatever the interest you are getting after maturity, 1.5 rupees, divided by how much you had invested, 98.5 rupees. 1.5 rupees interest, investment amount, that is 98.5 into 365, means for the money market transactions you have to take day count 365 by 9. What is the days? 91 days. 91 into 100. You can calculate 1.5 divided by 98.5 into 365 days in a year by 91 days, means invested for 91 days into 100 you will get in percentage. The customer is getting on in this transaction average yield for year is 6.1. Yield means always in the quoted in the year 6.1. This question also very frequently they are asking. Once again I am repeating. Issued for 91 days. Period is 91 days treasury bill. Normally treasury bills are issued for 91 days, 182 days and 364 days. So 91 days. Issue price is 98.5. The investor is investing 98.5. Face value 100. So on maturity, the investor is getting 100 rupees. How much interest he is getting? 100 minus 98.5, 1 rupee 50 paisa. Coming to this point, 1.5, that is the interest divided by investment amount 98.5 into 365 days count. In year 365 divided by 91 days. So investment amount period into 100, 6.1%. Now 140, this is a case study. One or two times in the BFM they had asked this question. G securities means securities issued by Government of India. Dated securities means up to 40 years also Government of India can issue. Dated governments or securities which carry a fixed rate of interest or floating coupon means rate of interest which is paid on the face value of the bond. Face value of the bond on half yearly basis. Whatever the Government of India securities are there, bonds, government securities, rate of interest, coupon payment is on half yearly basis. You have to understand one example. This question, model question I am discussing. Sometimes they are asking 5 marks. Please note it is 5 marks. For example, 7.17 government security. GS means government security. 2028 means it is going to be matured in 2028. What is the date of issue? 8 August 2018. It was issued on 8 August 2018. It means now you can answer, you can imagine the following things. What is the coupon rate of interest? 7.17. 7.17. Name of the issuer, Government of India. GSEC means issued by Government of India. Date of issue 8/8/2018. This is there already. Date of maturity, here we can see 2028 means 8/8/2018. This is a 10 years bond, but it was not mentioned this is a 10 years bond. So it is going to be matured in 2028. So 8 August 2018 plus 10 years, that is the date of maturity. Coupon payment dates. Suppose this is the 8th August means next 8th January and 8th July. Normally all these coupon payments in Government of India bonds are generally 8th January and 8th July every year. Generally this is the normally and generally of year 8th January and 8th July every year. And normally in the Government of India bonds minimum investment is 10,000. Minimum amount of issue sale is 10,000 rupees. This is there. And whatever the government securities are there, these securities are used for banks for SLR purpose. Whatever the banks are investing in G6, that is used for SLR purpose. So simple question, but you have to understand. Coupon is 7.5% is on GS28 means it's going to be matured in this date and date of maturity and coupon payment of yearly. Normally January 8th and July 8th and every year. No TDS on these bonds. These bonds are eligible for SLR. Minimum amount of issue is 10,000. So thank you very much friends for watching our YouTube. I think these informations are very useful. In our today presentation, I had discussed 4 or 5 case studies also, which are very useful. Huh? Please, my request to all the participants, please watch the video from beginning to end for getting true and real benefit of the presentation you will get. Thank you very much for watching our video.